All right, so the basics. These are the most predominant programs that you will see in mortgage lending, or at least in my side, right? So credit union side is going to be different. We're basically talking about traditional retail mortgage lending. One of the biggest questions I still get from people, believe it or not, from buyers that I'm trying to pre-approve is people still think that it takes 20% down to buy a house. And I mean, it's been a few decades now since that's been the case, so spread the word. You'll notice there's special conventional products that have a minimum down payment of 3%, and then there's your standard conventional. These are typically reserved for your first-time buyers. There is a product out there, in fact, Home Ready you can use for someone who is not a first-time buyer, but it has an income limit, and sometimes that can be a little more challenging, especially after someone's established himself and has a higher income. So this will be your standard conventional 5% down. All these go down to 620 credit score. We have to get automated underwriting system approvals. So when you get down to these scores, our buyers have to have some pretty big compensating factors. Like they gotta have some money in the bank, really low DTI. They gotta have something else going on that's gonna get them an automated underwriting system approval. This is the old standard. That's 20% down. On this product, there is no mortgage insurance because that's what Fannie and Freddie will securitize without mortgage insurance. FHA, USDA, VA, that's our Govy section. So you'll see FHA is a minimum down payment of 3.5%. Your USDA and your VA are both 0% down. VA, hands down, from a buyer's perspective, if they're a veteran, they have their entitlement, they've served our country, that is the best loan for them, period, end of story, there is no question. If you're a listing agent, maybe not so much, but if you're a buyer's agent and your buyer is VA pre-approved, there's no sense in looking at anything else as far as loan products if you want to serve your buyer. No, nothing down, there's no MI. VA is very flexible on underwriting. I've gotten a VA approval at a debt to income ratio of 71%. No other loan program will come anywhere close to that DTI. You can do other things, and we'll get to that in a few minutes with a VA loan that you can't do with other loans. So just keep that in mind if you're working with a buyer and they're talking about doing something different and they've been pre-approved VA, get them back to the lender so they can have a conversation and let that lender explain why it's such a good deal for them. Any questions about basic loan programs? You guys probably already know all that stuff.
Can they do VA for a second property?
To purchase a second home? No, but they could potentially buy a second or buy a home and use bonus entitlement. Let's say they're stationed somewhere, they buy a primary residence there, they get orders to go somewhere else. If they've got bonus entitlement, we can generally do another primary at a new place and they can keep that house without selling it. You gotta remember, these folks have served our country, they've sacrificed. VA wants them in a house. You know, I mean, you've got to really be in the most horrible shape financially of anybody to get denied a VA loan. And we manual underwrite VA. Basically, we manual underwrite these three categories. We can manual underwrite any of these three. Any of that cannot be manually underwritten. You have to have an automated underwriting system approval to deliver a loan to Fannie or Freddie. Any of these, we can follow their manual underwrite guidelines. If it's something out of the box, maybe their credit's not perfect, whatever, we can manually underwrite these. Still with these minimum credit scores here, but you know, sometimes if they don't have any credit whatsoever, no credit at all, we can establish alternative credit references with an FHA loan.
VA to VA is assumable, correct?
VA to VA is assumable, that is correct. Yep. If a veteran has entitlement, they want to assume another veteran's loan to get that great rate, they can do that. Has to be done through the current loan servicer, just like an FHA assumption. Can't go get a new bank involved. You have to go to that seller's lender, servicer, and apply with them.
And they're just assuming the current loan amount. They might have to make up the difference.
They will have to make up the difference out of their own pocket for whatever your sales price is compared to that loan balance. So this is a good tool for you guys to keep handy, especially when you're talking to having your first conversations with buyers and they say things like, oh, I had a bankruptcy. What kind was it? Chapter 7. When did you get out of it? Last year. Probably not going to be able to do a loan for them. If you want to know maximum loan limits for conventional, same thing there. Now these just or haven't been officially changed, but they are going up again. You guys usually don't run into that problem, so I wouldn't worry about it. But they are going up again for 2025. So again, you're going to see everything kind of broken out for you. Real easy to see. These are probably your most common things on this sheet that you're not going to know just off the top of your head and that can become really helpful in a conversation. Hey, I had a foreclosure. When was it? Okay, look at this. You'll know. This says dependent per AUS, but I would stick to this column to tell you whether we would get an approval on it here. Freddie Mac is a little more lenient with credit risk, so we do see their systems approving some things, but it's very rare. I do want to say FHA is a little bit lenient here on your Chapter 13. So if you've got someone that was in a Chapter 13, even someone who may currently be in a Chapter 13, we should have a conversation about that.
Well, because they've already discharged everything, they don't have any bills to pay.
Well, that's on a 7. That's on a 7. On a 13, they're doing a restructure agreement with the court. They've negotiated with the creditors and they're actually making payments on what's going to be deficient balances. So sometimes with FHA, 7 they pay nobody.
Okay, 13 is where they've agreed to pay.
Correct, and that's why you'll see these time periods for a Chapter 7 are typically longer, especially with conventional, whereas 13 they're a little more relaxed. FHA will allow a borrower still in Chapter 13, technically, to be approved. It does take a lot of extra work, and they're going to look really deep at that borrower's pay history in the bankruptcy.
When in doubt, send them to you.
Yeah, well, I mean, if they say, look, I've got money, I want to buy a house, I think my credit's okay. I had a bankruptcy last year, Chapter 13, or I'm in Chapter 13 bankruptcy now. Let's have a conversation. The court has to approve it if they're still in it. They can't go just buy a house without court approval, but we've done those before. They're not as hard as you would think they are. It's worth having a conversation. We start with their Chapter 13 payment history. We get that first, because if they have been off on that, it's a no-go, period. This is one of my favorites, and I think it should be one of y'all's favorites. Maybe not right now, but we are starting to see properties stay on the market longer, and we are starting to see sellers do some other things that they didn't used to do, like price reductions, and sometimes they'll pay a little closing costs. When you're negotiating for your buyer, please have this in front of you if you're asking for seller paid closing costs. I can't tell you the number of times I get this one all the time, and people have asked for $10,000 in closing costs, and it's a $200,000 home. And now we have to turn around and go back and renegotiate with the seller, and that gets really difficult once you've already negotiated up front. So please, when you're sitting down and you're putting together your offer, if you think the seller's going to pay closing costs, please pull this out and use it. This is the most common one that I see that we have to renegotiate on. I also see it here. Doesn't happen as often, but I see it there as well. On your VA, seller can pay all the closing costs, customary closing costs, which are basically anything for VA. In addition to that, a seller can pay up to 4% of the purchase price towards prepaids and non-customary fees. If you've got a buyer that's barely qualifying or maybe can't qualify and they need to pay off a debt, on a VA loan, the seller can do that. They can pay off multiple debts. If there's a repair that needs to be done or something you can't work out on your DDRR, that seller can go buy a $1,000 gift card from Lowe's and give it to that buyer on a VA loan. So that's why I say if you've got a veteran and they're pre-approved VA, there's so many benefits to using this loan. For veterans that's been doing this, it may be a little easier to go back and renegotiate, but if your negotiation toolbox isn't full, like you're newer to the game, and that's when it makes it more difficult, because you've given the seller an advantage at that point, and they can execute on it. Sorry, this is what we agreed to. If you can't use the money, well, sorry. This is another good one. I had this conversation with an agent yesterday, not in Mantle. Their listing has been under contract for 7 weeks. They've missed 3 closing dates, and the most recent reason they missed their closing date was the lender came back at the last minute and asked for a septic inspection on an FHA loan. The listing agent got smart and asked could they provide a copy of the appraisal. They provided the copy of the appraisal. The appraiser said nowhere on there, any comments, period, marked the septic system fine, and the lender will not close without a septic inspection. And they told the listing agent and the buyer's agent and the buyer that it was an FHA requirement. It is not. It has never been. Probably will never be unless we get into some massive lawsuit. But this sheet is gold too, right? These are agency guidelines. These aren't lender guidelines. This is what the agencies say. And if an agency doesn't require it, a lender should not be requiring it. If it came up, it's on our appraisal. We would know up front when the appraisal comes in, we would go back to the client and say, hey, sorry, appraiser saw doo-doo in the yard. You got to get a septic inspection. We would initiate that, right? This particular situation, the closing had been delayed 3 times already, and this was the most recent. But yes, an appraisal would tell us if there's an issue. That's the only thing in the file we would have that would tell us if there was an issue. Unless you do a septic inspection, the septic inspection comes back with some problems, your buyer does not pay for that out of pocket, the septic inspector wants it charged on the CD, then we don't have any choice. We have to get a copy of the septic inspection. If you put it on the CD, now the lender has to review it. Same thing with the pest inspection.
Yeah.
If you put a pest inspection on FHA CD, we have to review it. Is it required for the loan? No, it's not. But if we get word that a contractor is being paid for an inspection, whether it be septic or well is rare because we always get that on a well, or termite, then we've got to get the report. And if you haven't negotiated the repairs prior to close, the loan's dead stop until those repairs are completed. Don't send them to the attorney because the attorney, they get busy, it slips through, my closer gets a CD and there it is, and it's like, well, we're screwed now, right? So don't send them to the attorney, period. I mean, look, any lender can do what they want to do, right? But if they do that, that means they're not following agency guidelines. We only follow agency. We don't want all that stuff. If Fannie or Freddie's going to take the loan without it, why are we wanting someone to go get it? When I worked at Wells years ago, they were asking for things that Fannie and Freddie didn't want, and that was a bank overlay. I saw Bank of America do the same thing.
I had a conventional that the lender required a pest, so we gave it to them, and then some structural stuff came up, and then they required a structural because they wanted the pest in the first place on a conventional.
It's not required on conventional, it's not required on FHA, it's not required on USDA. VA is the only one that requires a pest inspection, and the seller must pay for it. That has always been traditional. They just changed this year and they've loosened up, and now they're saying the buyer can pay for it. Most of the time we see the seller pay for it now, even after the change. I think that change happened at the beginning of the year. But yes, that's the only one of these loans that absolutely requires it, and it's nothing we can do. And again, if you see something come back on that report and we are going to get that report, it has to be addressed no matter what loan type it is. And so if we get that report back, we have to know, did you have a structural go out there? Did you have a GC go out there? Has somebody addressed what the pest inspector saw? This is like probably our most common topic once we get under contract is stuff on the property itself. Even up front, Daniela and I do a lot of communication on the front side. She'll take pictures or video or whatever if we think there may be something that the buyer might have to be rectified prior to closing to at least alert the buyer and let them know, hey, this could potentially be a problem. These are the most common things we see come back on appraisals for each different loan type. This is where everybody gets wrapped up, right? Because we do a FHA loan, or we do a USDA is kind of a hybrid between a Govy and conventional, and they do go by HUD property standards. So these are probably the predominant things that appraisers are looking for so that the property meets HUD minimum standards. Appraisers vary, we all know that. Some will pick them apart, some might be a little more lax on things, just depends on how they're feeling that day or if you talk nice to them, whatever. But these are the things that they're supposed to be looking for on an inspection for FHA, USDA, and this is all similar for VA too. VA does appraise, the property standards VA are the most strict of all loan programs, which is why listing agents don't like them. If you're looking at foreclosure, this one's really important. Be sure that if you go under contract, you've communicated with the asset manager or the bank and that those utilities are turned on before the appraiser gets out there. If any of these things come up, they have to be addressed and fixed before we can close the loan. If they can't be, we can discuss a repair escrow. Those have to be approved separately. Those get a little tricky. Structural issues can never be put in repair escrow, so it's not an option, period. But some of this stuff we can do repair escrow if it can't be completed and we have the contractor lined up and kind of know a plan. These are your top 10 based on what we see with appraisals that come in. These are the most common ones that we see on FHA appraisals.
I was looking at this one that said missing screens on windows.
Mhm.
There's many homes that don't even have screens on
Mm-hmm.
them.
Correct.
You have to put screens on them?
No, but if the appraiser goes out and 3 windows have screens,
Oh, and others
4 don't,
Okay.
they got to put screens
If they
on them.
don't have any screens, you're fine. If they do have screens, then
So if you're missing them, either buy them or pull them all off.
Pull them off and take them away from the property. Don't
Yeah.
put them in a closet. Don't put them under a crawl space.
Okay.
Most appraisers would see no screens and they might see them in a closet and most of them would say nothing. But you don't know.
They might start counting.
They have a tough job and some are better than others. Application. So whenever someone comes to my website, does an application, our system's pretty automated for them. It's going to look at the data, got an AI, so it's going to look at what they put in, and then it's going to say, hey, Mr. Borrower, I need you're a salaried or W-2 employee, I need your W-2s for these years, whatever. These are the most common things that we see. So if you're having conversations with your buyers about getting pre-approval, tell them, hey, look, before you even start the application, go ahead and grab this stuff and have it ready because you're going to need it. Right now in underwriting, our biggest challenge, and this has been the biggest challenge for 2 years now, is income. Used to be assets before variable income came into play. It's not really assets anymore. Variable income is the death of most files. If you send a buyer my way and they're like, God, Toby's asking for this stuff and I can't, I don't have time. Understand the reason I'm asking is because I don't want your client going under contract and losing their due diligence money. I can't sleep at night. That is unconscionable, the number of people I see that don't get pre-approved properly. And income is where we spend 90% of our time on a file up front before we ever pre-approve a file. That's a good loan officer. Bad ones are like, oh yeah, you make $10,000 a month, okay, great, pre-approval. That is a sure way to lose a client money. If you have a buyer that has a pre-approval and they haven't given pay stubs and all this stuff to their lender, you need to send them to another lender. End of story. Variable income gets really tricky. A lot of people now fall into that category that didn't used to fall into that category 2 years ago. Problem with getting it right is every single agency, USDA, FHA, Fannie, Freddie, all of them have different underwriting guidelines for variable income. And all it takes is one pay stub or a year-to-date column does not make sense on a pay stub. And that's it. And then we're going down the rabbit hole. If you have a client that gets frustrated with that, try to back your lender up and say, look, they're just trying to help you the best they can so you don't lose money on a deal. Most of you, well, not the newbies, but most of you are already on the partner portal. It's great for putting leads in. It's great to see where your lead is at. If you're under contract, it's great to see what stage of the process is. Even though we do send automated milestone emails once you're under contract all the way through to closing. But if you get curious or I forgot, you can just get in the partner portal and see where everybody's at. Even your leads, you can see my notes. You can see if they've done an application. If they've done an application, you can see what we're waiting on to pre-approve them. All of that information resides in the partner portal. We do use this tool quite a bit too for promoting properties. We can help you promote the property, your listing or whatever. You can do it as a website, you can do it as flyers, however you want to do it. It is a little bit different than list reports, so if you're using list reports, that's fine. But list reports won't generate things like loan scenarios with payments and out-of-pocket expense and all that. This system does. The other thing is that why I joined Movement is the last section here. You know, I was a top producer at another company for about 6 years, and the owner of that mortgage company was very passionate about a specific charity. I'm passionate about a lot of charities, and for 5 years, even though I was one of his top producers, he wouldn't get behind the things I wanted to be charitable with in our community. Movement gets behind everything. The reason I stay there is because they support anything I want to get behind. So Movement's built around servant leadership, right? Technically, all those people work for me or whatever loan officer, but you have to fit their mold or the system doesn't work. Our mold is to give back, right? That's our mold. We're not out there making hundreds of millions of dollars and keeping all that money and giving it to shareholders or whatever. We give away up to 49% of our profit every year to the Movement Foundation, who builds schools, they go on missions, they support anything that they can do to give back to the community and help people. And that's why I'm at Movement. When you close a loan with Movement, not only do you donate, your buyer donates through the closing of that loan. And you'll see at the end of the year, some of you got them last year, your impact in the community, whether it was putting so many uniforms on a child in one of the schools, or so many backpacks that were full of food that we send home, or paying for a teacher's salary. All of our schools that we build are fully funded. All of the meals that go home with those kids are fully funded, all by us closing loans. So we're not out here to kill it and make money. We're out here to make the world a better place, or at least your community where you're operating. And at the end of the year, your buyer will also get, hey, look what great stuff you did by closing your loan with you in Movement. This is kind of what my website looks like when people get there. That's the button that we want them to click, start my application. If you send me a lead, I'll send them an email that sends them to that button, or I'll text them a link to the website so they can get started there. It's super simple. It's just basic information, but the process is really easy. Also on this site will be any reviews people have left about me that are not my Google reviews, but I always tell people go check my Google reviews too. But they can see the process and experience they're going to get by not only working with me, but working with my team. We pride ourselves on that. We want every client to have the best experience possible, and that's why we do a lot of work up front. Once they get under contract, they got enough to worry about with you guys. We don't want them worried about the loan.